change. So with that, let me pause. I'm going to introduce Ben Inker. Ben is the head of asset allocation at GMO, where he heads Wells Fargo Asset Allocation Fund and the Wells Fargo Absolute Return Fund. Of course, he holds the Chartered CFA designation, and please give a warm welcome to Ben.
Hi there. Thanks very much for having me. I come from Boston, where our baseball stadium is about 105 years older than this beautiful place. It unfortunately does have one thing in common with this room, though, which is obstructed view seating. This is a talk where I assumed people would be able to see the exhibits, and some of you probably won't be able to, and so what I say may not make a lot of sense. Sorry about that. If you have the choice between looking at me and looking at the exhibits, I heartily recommend looking at the exhibits. I'm actually giving two talks tonight, which are unrelated. One of them is useful, and the other one has to do with forecasts. I figured I had to do a forecast talk, but the difficulty is forecasting is tough. And forecasting, particularly on relatively short time frames, is really tough. So the first talk I'm going to give is something called Back to Basics, which is designed to be broadly useful for people who have to make investment decisions. And it's not really about how to forecast the stock market. It's how to think about investments you have to make and what should be in your portfolio. I was inspired to do this because I've spent a lot of years talking to institutional investors. And what I find is the things they say go in cycles. And back in 2000, I remember hearing investors saying the following things. Our pension fund is a profit center. Bonds are wasted space in our portfolio. We want as little of them as we can get away with. We're long-term investors. We need to have an equity-oriented portfolio. And this one was really very popular. International diversification is overrated. When you need diversification, the correlations go to 1. The backdrop for that was over the previous decade, stocks had beaten the pants off of bonds, and the US had beaten the pants off of the rest of the world. And people came up with arguments about justifying what had done well. You fast forward 2010, and what we were hearing from investors was very different. Our pension fund is not a core part of our business. Our portfolio should be first and foremost about matching our liabilities, the exact opposite of what we heard in 2000. Equities will play a smaller role in our portfolio. And another change, equities are growth assets. We should put our equity money into faster growing markets, into the emerging markets. Why were they doing that? Well, over the 10 years up until 2010, the S&P was down 1.3%. Trailing bonds by over 7% a year. It trailed emerging markets by over 10 points a year. And people came up with the arguments that had worked. Now, more recently, what do I hear? Our focus is on private assets so that we can exploit the illiquidity premia. Hedge funds have outlived their usefulness in our portfolio. US corporations are the envy of the world. They deserve a valuation premium to foreign stocks. Given low bond yields, high PEs are sustainable in the long run, and our equities and equity-like assets are all the inflation protection we need. Why are they saying that? Well, once again, equities have done very well. And again, the S&P, which from 2000 to 2010 was the worst performing asset, is once again the best, followed very closely by private equity. Bonds have been a lot worse. Inflation has been a non-existent problem. And hedge funds haven't done much. So the question is, how do we avoid doing this again in 2028? Without a strong anchor, it's really, really easy to let your strategic allocations drift. And the crowd is almost invariably a return follower. And the arguments you hear are the theories that would have justified the portfolios that would have done well over the previous cycle. And so the question of how do we get away from that? To me, it really comes down to having a strong anchor for your beliefs. And so I wrote a talk called Back to Basics, which isn't about answers, it's about questions. And I came up with a series of questions that I think you really need to be asking when you're looking at an asset class, when you're looking at a strategy. And it starts off with 3 very simple questions. Would I own this asset if I thought it offered no premium over cash? Where do the returns come from this asset? And why is my counterparty offering to fund a return to me? The crucial point of this is you need to understand what the purpose of something in your portfolio is to make sure it is fulfilling that purpose. You can't really understand what returns are going to be unless you understand where they come from. And I would argue that the last piece is one of those really underappreciated ones, particularly when you start hearing people talking about new strategies. Every return needs to be funded by somebody else. And in order for it to be a sustainable return, there needs to be a good reason why they are prepared to fund that. If you've got something that is uncorrelated and gives strong returns and does well when the markets do poorly, well, the guy on the other side has signed up for a really bad return pattern. And maybe he did that by mistake, but he's not going to keep coming back. So if you think, hey, this is an asset that's going to have a return premium over time, we really do need to understand why is the other side willing to come back. So I want to use these questions for a few different asset classes. Equities, a nice straightforward one. We all have equities in our portfolio. So equities, would I own this asset if I thought it offered no premium over cash? Well, that's easy. No. Equities are there for return generation. They lose you money at bad times. You wouldn't want to own equities if you thought they were going to give you the same return as cash. Where do the returns come from this asset? Also fairly straightforward. In the long run, they have to come from the cash flows and growth of the issuing companies. We may trade stocks between ourselves, but the long-term return to stocks has nothing to do with that. It comes from the dividends and it comes from the growth. Why would my counterparty offer to fund a return over cash? This one is also pretty straightforward. Equity is a risky asset for us as asset owners. It is a very low-risk asset for the issuers. If you want to make risky long-term investments, the great thing about equity is you never have to pay it back. There are no required payments associated with it. If you go through bad times, equity can never drive you into bankruptcy. So why do equities offer a risk premium? Well, in order to entice investors in, they really should. But the issuers of equities have reason to be willing to put up with those higher returns because it's the least risky way they can raise capital. Now, for bonds, life is a little different. Would I own the asset bonds if it offered no premium over cash? Well, I might. If I have a long duration set of liabilities, it may be a better match. You know, if you're a pension fund, cash is riskier than bonds because bonds match well with the liabilities. Where do the returns come from? Nice and straightforward. It's the interest payments from the issuing entities. And why would my counterparty want to fund a return over cash? Well, this one, I think your counterparty probably would. If you are making long-term investments, the nice thing about having long-term debt on the other side is you've got a better match, you've got less refinancing risk. So we're not certain that the investors in bonds require a return premium in order to buy them, but we have a pretty good reason to understand why issuers of bonds might be willing to fund one. Commodity futures, different kind of asset class that's in a number of people's portfolios. Would I own this asset if I thought it offered no premium over cash? Maybe. Maybe, maybe not. It may provide valuable inflation protection, and if I'm concerned about inflation in my portfolio, maybe this is something I'd be prepared to own even without a risk premium. Where do the returns come from? This one's a little bit more complicated. There's price changes, there's an underlying cash return, and then there's the roll yield, which is the difference between the forward prices in the market and the actual spot price when you get there. And why would my counterparty offer to fund a return over cash? This one goes back at least to Keynes. It may be that there are natural hedgers out there for whom guaranteeing a price is worth paying an insurance premium. So there may be some natural counterparty who's prepared to fund you in order to give them the insurance that they need. So those are the questions we think you want to ask before you do any analysis. And then you need to ask a few questions after you do the analysis. Are the returns consistent with what I thought they should be? If I thought I was going to get a return premium, do I get one? Have the valuations been consistent with the returns I thought I was going to get? Has something important changed? So let's look at that with regard to equities. This chart shows trailing 10-year returns of equities relative to cash. And what we can see is over time, going back to about 1930, the interesting thing is I can take stocks back a lot farther than that, but T-bills were only first issued in 1920. So it's the cash part of this that makes it harder to go back farther. We have gotten a pretty good equity risk premium of about 6% a year. So yes, we thought we were going to get an equity risk premium. We have. Can we explain where those returns came from? Yeah, we can. The average earnings yield of the market over this period has been 7%. We have wound up somewhat expensive relative to where we started, so we should have gotten an extra 30 basis points a year from the valuation expansion. The actual return we've gotten is about 6.5% real. So we haven't done quite as well as we might have hoped, but in general, the returns are quite consistent with the valuations, and they make sense given what we think we know about equities. Now the question is, has something important changed? This is a chart of the Shiller earnings yield of the market over time. We've averaged around 7%, but something does seem to have changed. For the last 25 or so years, we have been consistently below the average earnings yield of the period before. So maybe, and I'm going to blow up that more recent period, maybe the average earnings yield going forward is going to be significantly lower. Now, if that's true, it's consistent with a lower equity risk premium than we have seen in the past. But even at these levels, even at 4.5%, if we thought we were going to get 4% real, that's consistent with a lower equity risk premium, but not no equity risk premium. So if we go back to the questions, are the returns consistent? Yep. We thought we should get an equity risk premium. We've gotten a nice big one. Have the valuations been consistent with returns? Yes. Has something important changed? Yeah, maybe. Equity risk premium may well have fallen in the recent past as valuations have gone up. It doesn't look to have disappeared. And making it a little bit harder to tell exactly what's happened to the equity risk premium, bond yields have fallen at the same time. So maybe some of this is less about a change in the equity risk premium and more about a step change lower in overall returns. If we look at bonds, we thought there might well be a return premium here, and there has been. You've gotten about a point and a half % a year better than cash, but we did have a 40-year period where bonds lost to cash. And 40 years is an unpleasantly long time. It is at least as long as the average career. It would kind of stink to be expecting a positive risk premium and walk in at the beginning of that. From the standpoint of has something important changed, well, this is the yield of bonds going back to 1920, and you can see we are at levels lower than we have seen for about 60 years. So, are the returns consistent with what I think they should be? Yeah. Hasn't been a huge risk premium, but we weren't sure whether it needed to be that huge. Evaluation's been consistent with returns? Man, they better be, because bonds are nice and simple. They're fixed income instruments. The return is the income. Has something important changed? I'd argue pretty likely. Bond yields are near all-time lows. And one of the things that may be interestingly different is 60 years ago, nobody talked about liability-driven investing. Pension funds kind of existed. Insurance companies certainly existed. There were entities out there with long-duration liabilities, but nobody thought in terms of matching their assets to their liabilities. So it could be the case that going forward, we're going to see a smaller return premium for bonds over cash because suddenly there's a whole lot of people who think of bonds as a lower risk asset. Okay, commodity futures. Has there been a return premium over time? Yeah, hasn't been huge, but you've gotten about 2 points better than cash. Have the valuations been consistent? Well, it's interesting if we look at where those returns came from. Whoops. This shows for the GSCI index what's happened to spot prices in real terms. So in real terms, what we've seen is commodity prices haven't quite kept up with overall inflation. You certainly haven't made money from commodity futures because the real price of commodities has gone up fast. A way you have made money, and certainly a way you used to make money, is from the roll yield. And if we look at the era before the GSCI was created, they went and backfilled back to 1969, but this thing was created in 1992. Before that, I'd argue that commodity trading was really only the province of speculators. And when there's only two groups, the hedgers and the speculators, it makes sense that the hedgers had to pay the speculators to get involved. The thing is, that's not the way the market works anymore. Sometime around 1992, the hedge funds started to get into the game. And the hedge funds didn't require as big a return because they could diversify the risk. If you are a pit trader in commodities, what matters is, oh my God, what is happening to the price of natural gas? If you were a hedge fund trading across a dozen commodities and stocks and bonds, what happens to natural gas doesn't matter that much to you. And so we saw a change where the roll yield went from positive to negative. And then in the more recent period, we've seen the roll yield be profoundly negative here. Ever since commodity futures indices became popular, we've seen a pattern where you make a lot less money than the change in spot price for owning commodity futures. So, have the returns been consistent with what we think they should be? Well, we weren't sure whether there should have been a risk premium. There's been a small one. Have valuations been consistent with return? Hard to say. Roll yield is one of those tricky things that's hard to understand except ex post. But one thing we can say is, insofar as there have been positive real returns to this strategy, it's come from a combination of the underlying cash return and the roll yield. And has something changed? Oh yeah, it's changed. That roll yield used to be significantly positive. More recently, it's been significantly negative. If that sustains, it's hard to see how there could possibly be a positive risk premium associated with being long commodities. And if anything, maybe now you have to pay people to take the other side. And if there's a risk premium, it is associated with being short commodity futures. So the nice thing about all of those situations was we had a lot of data. So we could look at this stuff and answer a lot of questions. In lots of cases, we don't have great data. I'd argue it's still worthwhile to look at these questions in a somewhat similar way. So I'm going to take a few examples. Private equity. Would I own private equity if I thought it offered no premium over standard equities? Of course it's got to give an underlying equity risk premium, but would I own it if I thought it had the same return as normal equities? Probably not. It's less liquid. It's more of a pain in the butt. I do know some investors who seem to like the apparent diversification that comes from the fact that appraisal values lag. So they get some stability out of that. Not very many people are prepared to admit that's why they have private equity in their portfolio, though. Where do the extra returns come from private equity? This one is a little bit complicated, but it's important to think about. The extra returns have to come from one of a few places. Either it's the people you bought the company from, the people you sell the company to, or the lenders you can fleece along the way. All of those could be perfectly good ways to get returns, and maybe you are just simply better at managing companies than normal management. Why would your counterparty offer to fund a return above standard equities? Well, given those sources of return, they're not doing it on purpose. The equity holders, original equity holders, aren't hoping to underprice the company when they sell it to you. The people who buy it when you take it public aren't hoping that they're paying too high a price. So nobody is systematically wants to do this. Nobody systematically wants to give you the higher return. But this could be an effective way to exploit their inattention. And maybe inattention is sustainable. If we look at venture capital, it's a slightly different world. But would I own this if I thought it offered no premium over standard equities? No. Venture capital is riskier. It offers no obvious downside protection. Man, if I'm buying VC, I really hope it outperforms. Where do the extra returns come from? Well, in this case, it's a little bit different. You've got entrepreneurs who need capital in public markets that aren't prepared to provide it yet. So entrepreneurs may be willing to provide higher returns to you because they have very few other places to go to get the capital they need. And why would my counterparty offer to fund a return above standard equities? Because there's very few other sources of capital. So VC is different from private equity in this important way. Now, the problem is we don't have great data. Are the returns consistent with what I think they should be for private equity? I haven't the faintest idea. I haven't been able to find two indices of private equity that agree on what the returns have been. So I don't know. Have valuations been consistent with returns? I don't know. I don't know what the returns have been. Has something important changed? Well, despite the fact that I couldn't answer those previous two questions, yeah, something has changed. The amount of money invested in this asset class has grown by orders of magnitude. So if this used to be a play taking advantage of some inefficiencies that could exist when done at small scale, that would be a problem because we're no longer doing it at small scale. VC, we've got some of the same problems. Are the returns consistent? We don't know. Have the valuations been consistent? Even harder to answer than within private equity. Has something important changed? I'd say probably. We've got the same problem we had with private equity, which is there's a ton more money invested here than there used to be, except some of the sources of return here may be hard to compete away, in that part of what an entrepreneur gets from VC is capital. Another part is advice and access. And the really good VCs can still offer that in a way that other people can't. So maybe you've got entrepreneurs that are prepared for the right VC to sell out at a lower price than they would for somebody else, even though there's more capital invested there. So I want to try a couple of other asset classes. This one I put together a little while ago, so it seemed less on point than it does now, but volatility. Would I own this asset if I thought it offered no premium over cash? Well, we have to define what we mean by owning volatility. But what I'm saying is being long volatility. So would I go long volatility for the same return as cash? You bet I would. It protects me against bad market events. That's cool. If I can get that insurance for no cost, I should take it. Where do the returns come from? It's basically the difference between implied volatilities and realized volatility. And why would my counterparty offer to fund a return? Well, this would be weird. If we're not going to have a situation where implied volatility is higher than realized volatility, my counterparty is going to lose money over time, and they're going to specifically lose money whenever anything bad happens in the market. They may do that for a little while, but it's hard to believe they're going to do that again and again. So we do have some data on volatility, so we can look at it. This is the difference between implied volatility and future realized going back to 1996. There has been a gap. There's been a gap of about 2 points, which has been enough to make being long volatility an expensive proposition and being short volatility a decent way to make money. More recently, and there's no way you're going to be able to see this, maybe these things have moved closer together. And in fact, if I look across various markets that have reasonably liquid options, what we see is consistently since about 2014, the gap has shrunk. It hasn't disappeared, but it's shrunk. So what can we tell? Are the returns consistent with what we think they should be? And we don't have a huge amount of history, but being long volatility has definitely cost you money. Have the valuations been consistent with returns? Yeah. Implied volatilities have been high relative to realized, which means being long volatility is going to hurt you. Has something changed? Come on. Possibly. Vol selling has become more popular, and we do see some shrinkage in the implied realized gap. Cryptocurrencies. This one seemed more relevant about 3 weeks ago. Would I own this asset if I thought it offered no premium over cash? Actually, I very well might. If I lived in a country where I did not fully trust the government and I thought I might have to leave, this is an asset I can take with me. That was always one of the arguments behind holding gold, and what we have seen is in most events where you have to flee the country, you can't take your gold with you. You can take your cryptocurrencies. As long as you've still got, your password, you've got it until it gets stolen by some cyber thief. Where do the returns come from in this asset? Well, this is where life gets a little weird. There is no income, there is no growth, there's no roll yield, there's nothing really here in a traditional financial sense. And why would my counterparty offer to fund a return above cash? Well, my counterparty, the issuer of this, is an algorithm. And it's got no obvious desires or concerns, wants, needs. It's an algorithm. There could be a return here, but it's really hard to call this a traditional financial asset. Its purpose is not to generate return. So I think the nice thing about this is these are nice, simple questions that you can use for an asset class. You can look at them for a strategy. And no matter what's going on, no matter how much information you have, it's a nice way to anchor your thoughts about the asset classes you've got. And so what we think you've got to do is start with the basics as your anchor. Start with the things you would own without a risk premium when you're building your portfolio. If that's long-term bonds, great. If that's cash, fine. Add risky assets only where you're confident there should be a risk premium over time. And finally, always be nervous about an asset or a strategy where it isn't obvious where the excess returns will come from, and it isn't obvious why your counterparty will be continually interested in funding those. And the last thing is, and one of the things we believe very strongly, be prepared to drop anything from your portfolio if it's not priced to deliver what you need from it. Your low-risk asset, fine, you own when it's cheap, you own when it's expensive. It's your default thing to own. But if you own equities for return generation, make sure the equities you own are priced at a level to give a good return. If they're not doing any good in your portfolio. Okay, so that was the useful part of the talk. Now we're going to have the forecasting part of the talk. Some of you are probably familiar with the way we do asset class forecasting, and of those, some of you like it and some of you don't. Our current outlook is not particularly rosy. It is an expensive world, but one of the things I always remind our clients is you have to own something. You do not get the choice to sit it out and wait. A portfolio that is fully invested in cash is still a portfolio that is fully invested. So quickly on the backdrop, and Matt talked about this, so I won't spend much time. The global economy really does seem to have finally recovered from the financial crisis. All major regions are growing decently. Risk assets have celebrated the growth. What I'd say about the valuations of risk assets is they're running this tightrope. They are assuming there is going to be significant future growth and that growth will not lead to either inflation or tight monetary policy. They could be right. They've been right so far, but that's a really strong assumption to make. If markets are right, long-term returns are going to disappoint because the reason why it's okay to pay these high prices is because the required return to all these assets has fallen. If markets are wrong, then in the medium term, returns will not merely be disappointing, but really pretty bad. Because then we need to see valuations reverting to lower levels, and that involves losses in most cases. We have gotten strong returns, but since Matt went over this stuff, I won't spend much time on it. I did want to point out one interesting thing about last year is it was an extraordinarily good year for growth stocks relative to value stocks, co-equal best since 1999, and has left growth stocks trading at much bigger premiums to value stocks than was the case a few years ago. So what is the world going to do going forward? I don't know how to do short-term forecasts, but the problem with doing long-term forecasts, which is what I generally try to do, is the future may or may not look that much like the past. And today we see kind of a couple of different scenarios for the world, which we refer to as purgatory and hell. Now, that begs the question, what about heaven? Could we be in heaven? I wish we could be in heaven. Heaven, to me, is the old world where you got 2.5% to 3% real from bonds, and you got about 5.5% to 6% real from stocks. That is heaven. The bad news is it is very clear we are not in heaven today. The valuations of stocks and bonds are simply not consistent with earning those returns in the long run. It just doesn't work. Purgatory assumes that over some period of time, in our case we use 7 years, where we are going to gradually revert to those valuations. So the yield on bonds is going to gradually move up to something 4.5%. Normalized PEs for stocks will move to around 16 times. If that happens, we're going to get some bad returns because today's PEs are higher and today's bond yields are lower. But the good news is from year 7 into the indefinite future, we're back in heaven. The alternative is that doesn't happen. And in that world, the reason why it's sustainable is the required return to stocks and bonds has permanently dropped. The good news is if that's true, stocks and bonds are not so overpriced. The bad news is everything, all of the heuristics behind savings behavior, behind spendings for endowment and foundations, behind the math and pensions, doesn't work. Because more or less all of that assumes you can get 5% real from a diversified portfolio. And in this hell scenario, that's impossible because stocks give you less than 5 and bonds give you less than stocks. There is no unlevered way to combine those two to get to 5 anymore. So what does that mean? And since you can't see these exhibits very well, I'll skip over some of them. This chart, for those who can actually see it, shows the two different scenarios, the purgatory and hell scenario. The purgatory scenario is the solid one. The hell scenario is the cross-hatched one. And what you may or may not be able to tell is the hell forecasts are all higher. And the reason why they're higher is because we don't need to see the big fall in valuations. But it still doesn't make things rosy. We think even in the hell scenario, even if US stocks only need to deliver 4.5% real, they're still too expensive. The US stock market's been on a heck of a run. And we think we're trading around 30 to 33 times normalized earnings. And even in the hell scenario, we got to be trading at 20 to 22. And that's a lot that you've got to absorb even over 7 years. If you got to go all the way back to 16, that's even more. One interesting thing about the impact of the hell scenario is even though what it means is a parallel shift down in required returns, the impact on expected returns is not parallel. It is for stocks. The difference between the returns for stocks is basically all about 3 points. You can add 3 points to all of the forecasts for the hell scenario, and the reason why is because the discount rate is about a point and a quarter lower, and equities in round numbers have a duration of about 20 with regard to the discount rate, so they all get affected the same way. Bonds are shorter duration than equities. I know people aren't that used to thinking about the duration of equities, but if you think about an equity like a bond, first, it's a perpetuity. It never matures. And second, even relative to a console or a perpetuity, it's going to have a longer duration because its cash flows grow. So cash flows 20, 50, even 100 years from now are going to matter for the present value of equities. So they're a really long duration asset. So a change to the discount rate actually matters more for equities than it does for bonds. And of course, it matters more for bonds than it does for cash, because the thing about cash is it's the zero duration asset. And that leads to a problem in putting together a portfolio if you're not sure which of these scenarios we're in. And right now, we're not sure which we're in. I want to take our forecasts and use them in a slightly different way. Rather than focusing on the individual forecasts and what they mean for, say, US stocks or emerging stocks, I want to look at the general return to risk that seems to be embedded in pricing. And these charts, hopefully, this is simple enough to be able to see. What we really need to focus on is the slope of that regression line. And this chart shows what that regression line would look like if everything was priced exactly normally. You'd have a slope of about 0.7. Don't worry too much about what the units are. Now, the world spends very little time at fair value. But even when the world is screwed up, the general risk-reward trade-off doesn't need to be. This is what the world looked like in 2000, a giant equity bubble in the US. Internet stocks would have had a forecast well below the bottom of this page. But the slope of the line was still positive because there were risky assets that were priced to deliver good returns. REITs had a yield of 9. Emerging equity was cheap. Emerging debt was cheap. The other thing that, in retrospect, was stunning about the world in 2000 is how easy it was to imagine how you'd make money. Because on the low-risk end, you could buy tips at over 4% real. So putting together a portfolio to achieve 5% real was dead easy. You just had to avoid large-cap developed market stocks, and you could do it by throwing darts at a board. 2007 was the next bubble, and it was a very different bubble. Nothing was as stupidly priced as internet stocks were in 2000. But whereas in 2000, the general risk-reward trade-off looked kind of normal, here it didn't. This was what we think of as the great risk bubble. Back then, the great moderation had people convinced that economic downturns wouldn't occur anymore. And so they stopped pricing in an assumption that risky assets had to offer a risk premium. As a result, what we saw was you were paying for the privilege of taking risk. It's pretty easy to know the right thing to do then. It's not necessarily so easy to pull it off, because if you take your client's money and stick it all into tips and cash, they're probably not going to be thrilled. They know they're not going to get the returns they need out of that. But back then, you know, the tips were yielding 2.5% real, cash was yielding about 5%. Those low-risk assets were giving a pretty nice return. It turned out the great moderation wasn't that moderate, and we wound up having the worst economic event since the Great Depression. When that happened, the pricing of risk changed. And by the winter of 2009, we went from the slope of this line going the wrong way to the slope of this line being twice normal. And every risky asset was priced to give a strong return. I'm not going to pretend that it was really easy to know what to do with your portfolio back then, because it was a very scary time. But if you looked at pricing, what you knew was, well, I'm getting paid a lot for the sleep I'm losing. If we fast forward to today, we get this line. It's not as screwed up as it was in 2007, but it's completely flat. So if we are in purgatory, and this is using the purgatory forecast, then it really doesn't make sense to take risk today. The trouble is, in the exhibit that somehow didn't make it onto here, for which I apologize, the hell version of this still has a meaningfully positive slope. So the big difference between these two scenarios, one where rates stay low forever and the other where they go back up, is if rates are going to go back up, don't take risk today. You're not getting paid for taking risk. If rates are going to stay low, take risk. So this means we have a problem. We have two scenarios, both of which we consider to be reasonably plausible. And in one of them, you should be running a very low-risk portfolio. And the other one, running a normal amount of risk makes sense. So what can you do about that? Well, what that means to us is we can't run an optimal portfolio. We can't run a portfolio that is really well designed for purgatory, because that portfolio is not going to make enough money in hell. And we can't run the portfolio that is really well designed for hell, because that's going to lose you too much money in purgatory. What we're focused on, given that uncertainty, and this one is going to be impossible to read even for those of you who can see the charts, is a robust portfolio. which is a portfolio that can survive either of these two scenarios, because frankly, we don't know which one we're in. It would be very convenient to know, because the purgatory portfolio and the hell portfolio don't look very much like each other. But in the absence of that knowledge, we think what you have to do in putting together a portfolio is make sure you can survive either one. You don't want to be in a situation where you think, hey, there is this meaningful chance where the world is going to evolve in a way that I'm going to look like an idiot. So what are the key elements to winning in either scenario? We think, first and foremost, make sure you own the right equities. Today, we think that is first and foremost emerging markets value to own, the equities to avoid, US equities. Shorten duration where you can, because the difference between purgatory and hell is all about what happens if discount rates change. If you can find shorter duration ways of taking risk, you've got a lot less to lose if discount rates move back up. So we think alternative assets, alternative hedge fund-like strategies make sense today. Short duration fixed income, including short duration risky fixed income, makes sense. Because this isn't 2007. It's not the case that spreads are so tight that it is obviously silly to take risk. It's just that it is generally easier to take risk. There's more ways to take risk in longer duration fixed income than there is in short duration fixed income. We think it is too early to abandon risk-taking entirely, although it's hard for us to get excited about taking as much risk as one would in a normal portfolio. And then kind of the question we grapple with, as the economy evolves and as we see what goes on, particularly with inflation, because I think at the end of the day, inflation is going to be the driver of which scenario we wind up in. If inflation really does become a problem and the Federal Reserve has to tighten materially more than the market is expecting, hell is off the table. If inflation stays surprisingly absent and central bankers can stay easy forever, then we're probably in hell. But how high does our conviction have to get in which scenario we're in to move away from the robust portfolio to the optimal portfolio? If you had full certainty, you really want to be in the optimal portfolio because it's just better. But right now we say, we think there's about a 33% chance we are in hell, 67% that we are in purgatory. If we could get that to 80-20, is that enough to move to the purgatory portfolio? I'm not quite sure. 20% chance of looking stupid is still a reasonably high chance. Okay, so there are some things we think you can do that are not that impacted by the purgatory versus hell problem. And most of them exist within equities. And the reason why equities aren't that impacted is because they're all impacted in the same way. If you want to own the right equities, it doesn't matter whether we're in purgatory or hell. Now, why is it that we dislike US equities? It's not because we have a problem with the US economy. It's not because we think US corporations are run badly. It's because the US has just beaten the pants off the rest of the world. This chart shows the relative returns to the S&P versus EFX Japan going back to 72. There are these big cycles. It started off with the S&P winning by 37, then EFX Japan won by 71, the S&P by 96. The most recent cycle showed the S&P winning by 105, the largest win it's ever had. Since then, EFX Japan may have turned the corner. It's up a relative 5%. But if you just look at this and you say, well, we've got one asset which has just beaten another asset by 105 percentage points, would it seem that weird if that asset was more expensive now? To us, it doesn't. And since equities give returns driven by their valuations, we think it's relatively straightforward to understand why non-US equities might look better. In particular, emerging markets, which despite their strong returns last year, the most recent cycle was 142% in favor of the S&P. We have some clients who have been asking us, is it time to sell emerging? They've had the nice run. Maybe this is over. Maybe. But all of these cycles before this have averaged somewhere north of 100 percentage points. And so far, we've gotten 14 percentage points of EM outperformance. So our view would be there's plenty of room for emerging markets to run. Come on. And so what that leaves us with is some really interesting relative return opportunities. We think EFA stocks are close to as cheap relative to US stocks as they've ever been because they've just lost by the most they've ever lost by. Emerging markets, went through a period of time where it lost by 440%. So we're not the cheapest emerging has ever been relative to the US, but it's a wide range, and it looks very good. We also think quality stocks are worthwhile in the US. But within emerging, there's something else which makes emerging look particularly interesting today to us, and that is the fact that it's not just about broad emerging, it's about value stocks within emerging. Now, value stocks always trade at a discount to the market. They wouldn't be value if they didn't. But sometimes that spread is wide and sometimes that spread is narrow. What this chart shows is the spread of value for the cheap half of emerging, where 0 here is the average. And right now, we're about 1.2 standard deviations below average. So the spread of value is meaningfully wider than it has been on average. And on average, value has won in EM by about a point a year. So we think right now, value is priced to beat EM by a good deal. And that puts us in an interesting situation because EM was already the best priced asset class we could find. If you then say, and value is well positioned within EM, you have the situation we find ourselves in today where this chart takes our favorite asset class and looks at the difference between our asset class with the highest forecast and our second favorite asset class, going back to 1994, which is when we started publishing our asset class forecasts. And right now, it's not that EM value has never been cheaper than it is today. It was a lot cheaper in 2002 in absolute terms than it is now. But the gap between EM value today and the next best asset is the widest we've ever seen. So that margin of superiority is absolutely huge. And so for us, the dilemma is not, should we own EM value? Yeah, we should own EM value. It's, how much should we own of EM value? The cost of diversifying into the next best asset is really high today. On the other hand, EM value is the riskiest asset we know how to buy. So we shouldn't have 100% of our money there. So what can we do when we're thinking about that? Well, we do a couple of things. One is we look for other factors which really can impact the risk of the asset class. One of them is currency valuation. It's easy to not pay much attention to the valuation of currencies when you're looking at the valuation of stocks, but it really does matter. EM currencies were horribly overvalued back in 2011. They were really quite cheap in 2016. Now they're neutral. So I don't expect much either way. The other factor we really care about is the state of the credit markets. If you are seeing very rapid credit growth, you can have real problems in the economy. And if you look at circumstances in which relatively cheap assets have done poorly, it's usually when there's some kind of a banking crisis. So on that basis, right now we see emerging as almost exactly neutral, which is to say the risks don't look that high. That's missing the fact that they do look pretty high in China and they look quite low everywhere else in emerging. So this gives us some pause, but at least it doesn't look like a particularly risky time to own EM. And so what we're trying to do is have conversations with our clients about, well, what is the most EM that makes sense given the problem you're trying to solve, and getting there. So in conclusion, I've been talking for a while now, returns are going to come down. They are coming down whether valuations revert or not. If valuations are going to revert, investors really do need to get defensive because the returns are going to stink for a while. If valuations stay high, taking risk is okay, But the bad news is holding a normal portfolio today assumes valuations are going to stay high. It also assumes that current spending models, current savings models are simply unsustainable. You can't spend 5% a year from an endowment or foundation in a world where nothing gives you 5% a year. You can't save enough for retirement if you're saving the 9 or 10 or 11% of your salary that everybody says is enough if you're not going to earn 5% real on your retirement savings. And if you are a pension fund shooting for whatever 7.5% nominal, you're not going to get it if bonds are yielding 2.5 and the equity earnings yield is 3. So we're in a position today where either we're going to have to start changing the rules of the road, changing how we think about our savings and spending decisions, or we're going to be in a world where returns are going to stink for a good deal of time. In either scenario, we think emerging markets are the standout asset today. They're the one thing that is constant between them because they're the one asset which, even if valuations have to come down, is going to give a pretty good return. Okay, so with that, I've given you something useful and something depressing. And hopefully you've had some dessert, and we can have a little bit of time for questions.
Thank you so much for your insightful presentation. You have a wonderful deck here, so if anybody would like a copy, please reach out to Kathy at Atlanta Society of Finance and Investment Professionals, or to Zach Brydeski. I'm sorry if I'm mispronouncing your name. Zach, please stand up so that everybody can see you. So please reach out to Zach. And we've got 2 mics, one on that side and one on this side. If you have questions, please come up over here.
Thank you so much. I've been in the business a long time, and I think that one of the things that we're not recognizing as capital owners is that returns to capital have been extraordinary during my lifetime, and that finally returns are moving to labor. $11 an hour at Walmart, $15 an hour at Target. I mean, these are not small numbers. And I'm not sure that we really recognize how that multiplier effect can, in the long term, return money to capital owners just because the top line's going to grow. Poor people spend the largest majority of their income in the market, and you have this huge multiplier effect. And yet, I don't think we really recognize that after years, all of these charts and quantitative techniques assume returns are normally distributed. Not. So I'm just saying it's time for labor to step up a little bit, take returns from capital, but in the long run, it's better for us.
Yeah, I think that's right. I think it would be far better for the economy. I think it would be better for social stability. It's obviously not great for the stock market because it means profit margins, which have widened hugely, have to narrow down. And they really do have to narrow if wages are going to be rising, because the big cost for corporations is the labor cost. And the flip side of profit margins being really wide is the labor share of output has been really low. I hope it comes back up. I hope so on behalf of workers. I think from a social stability standpoint, we would all be better off. And frankly, from a long-term economic growth standpoint, we'd all be better off. As capital holders, you know, you're better off if you get a bigger piece. But as you were saying, we've had it good for a while. And I think some turning the other way is overdue.
Our surveys of portfolio managers and research sources suggest that universally, every single source that we have access to has said the number one pick is emerging markets. My 40-year plus history, actually now 50 years, in this business says nobody that is that universally acclaimed is right. Respond.
Yeah. I think it's a fair point. You know, the consensus is not right that often. It's not always wrong. The thing I can say in favor of emerging, despite the fact that it seems to be the consensus call right now, is it hasn't been the consensus call very long. You just have to go back to 2015 or early 2016, and the questions we were getting from clients is, isn't emerging a broken asset class? I mean, isn't it a stupid idea to invest in these economies because they don't have the rule of law and, you know, they don't have the corporate governance, and sure, they're trading at a discount, but it's not big enough. And 18 months of really good performance will change that. And now it does seem to be the consensus play. I don't know. We are referred to as contrarians. We are not knee-jerk contrarians. We are contrarians because usually the consensus is in favor of things that have done well and look expensive. Today, emerging had traded to a big enough discount that despite the fact that it's done pretty well recently, it still looks to us to be the cheapest thing out there. Bad things can and will happen to emerging again. I hope not right now, because our portfolios have a ton of it.
But just a quick follow-up. You've also made the point that value is the place to invest in emerging. Can you drill down into something a little more specific in terms of value, either sectors or even individual securities?
Well, I'm certainly not going to get into individual securities. With regard to sectors, the good news is it's pretty widely diversified. If you look at value traditionally in EM is pretty resource heavy and pretty financials heavy. And today, the resource companies and the financial companies do look pretty cheap. But even if you threw them out, the spread between value and growth is pretty wide. So the thing I like about today with regard to value is you can put together a really diversified portfolio. You can find stuff in financials. You can find stuff in consumer durables. You can find stuff in the cyclicals. You can find stuff in IT. Kind of hard in healthcare, but almost everywhere else you can find cheap things to own. So you don't have to be that focused on a particular area or indeed a particular region. We are finding more cheap stuff in more places in Asia than we normally do, but we can find interesting stuff to buy in Latin America and Europe and across a wide array of industries.
Okay, I've asked a lot of people here in the audience. Let me ask you, do you think we are in a correction, i.e. down 10% but not a new bear market in the US? And if we are in a correction, traditionally corrections evolve into old leadership fading away and new leadership coming to the fore. What might that new leadership be? So kind of two parts, and maybe you can skip part two by answering part one by saying we're not in a correction.
Yeah, I don't honestly know whether we're in a correction. The interesting thing about what perhaps may have been the trigger for all of this is it did seem to be driven by this sense that wages looked strong in the employment data, and maybe inflation was coming back. I do believe that today the worst thing that could happen to financial markets and most diversified portfolios would be a significant inflation problem. It obviously hits bonds. Bonds always hate inflation. Equities are often thought of as a pretty good inflation hedge, and the cash flows are well protected against inflation. The thing is the valuations are not. And today's valuations only make sense in a world where rates stay low. So are we in a correction? I don't know. Is this the turn of inflation? If it is, I think we're not merely in a correction, but probably a bear market. I think it's way too soon to know whether inflation is really going to start to rise. But I think if it does, even if earnings are pretty strong, I think you could see a surprisingly sharp fall in the equity markets, because valuations today demand monetary policy that's going to stay low into the indefinite future.
Any more questions from the audience? Well, Ben, thank you so much for your insightful presentation. We really appreciate it.
Thank you.